Hello, and welcome to another episode of Readings in Impact Investing, the show that features important readings in the world of impact investing, sustainable finance, development finance, and ESG through the medium of audio. This podcast is a non-profit initiative made available as a public good, and its ongoing operation is supported by community donations. Find the podcast online at readingsinimpact.org or on your favourite podcast platform. Now here's your host, Daniel Rosehill.
Hello friends and subscribers, welcome back to another episode of Readings in Impact Investing. This is brought to you by myself, Daniel Rosehill. It is a new podcast being mirrored onto YouTube, and the purpose is to take dense written material in the field of impact investing and bring it into audio so that you can listen to this wherever you might feel the urge to listen to a podcast. The home of the podcast is readingsinimpact.org. That is a website where you can find links to all the different places that this podcast is syndicating out to, so where you can find it. So Spotify and Apple Podcasts seem to satisfy most people, but there are other places as well. And of course, it's being mirrored onto YouTube. So whenever I publish an episode, it automatically copies onto YouTube, which is I'm pretty happy about how well that integration actually works. So today we are going to be talking about sovereign sustainability-linked debt. We have talked about sustainable debt recently. It's a very relevant area. There is sustainable debt in the form of sustainable bonds, social bonds, green bonds, transition bonds. What else is there? SDG bonds, and also, of course, sustainability-linked bonds, SLBs. And those are a bit different, as we've talked many times, based on the fact that they're not just use of proceed bonds for sustainable purposes. They actually have a what they call specific performance targets, SPTs, which basically change the cost of the debt according to the borrower's success in reaching sustainability targets. And they're supposed to be ambitious ones. That's another point that's been made in the criticisms or potential pitfalls in the mechanism, that they're not supposed to be issued for business as usual sustainable objectives. Rather, a company is supposed to set a sustainable objective, and if they do achieve that, then they're going to be compensated through cheaper debt, a step down coupon, and there is a step up coupon if they go in the other direction. So these so far have been mostly used by corporates who are looking to improve their sustainability performance and who need to raise debt. But I discovered today this entire movement that is dedicated to pushing the case for the use of these instruments among sovereigns. The world's first sovereign SLB, this is one fact I can rattle off, was issued by Chile in 2022. I don't know much about it. I haven't actually even looked at what the Chilean government raised the money for yet, but I will get around to doing that. But I do know that the SLB issuance has been, the vast majority has not been by sovereigns. So the Sustainability Linked Sovereign Debt Hub is just because, you know, we all needed one more acronym to remember today. It's SSDH, okay, Sustainability Linked Sovereign Debt Hub, and their website is up at ssdh.net, and they are all about this. So I'm going to just actually read their about page before I read their blog. The blog is called the Understated Benefits of Sovereign SLBs. But let me firstly introduce the organization, because hopefully they do actually have, not hopefully, they have a lot of reports, which is always something I'm excited about, and we can hopefully read a couple of those in time. I'm being guilty of multitasking because I'm currently adding the report URL into my little tracking document where I put all these to peruse later. So let me get back to doing one thing at a time. About the Sustainability Linked Sovereign Debt Hub, the challenge. The world currently has a substantial problem with high levels of debt. The total global debt has surpassed $300 trillion in 2021, with 80% of new debt burden in 2021 coming from emerging markets, where total debt is now approaching $100 million. Unless something is done to address the world's debt, food security and energy security issues, as well as socio-economic and political unrest, are set to increase significantly. Today's sovereign debt markets are not fit for purpose, as they fail to take adequate account of the sustainability risks, which increasingly are having a material impact on countries' economic growth and resilience. Vulnerable nations are excluded from accessing the affordable capital and investment that is urgently needed to create sustainable economic growth and adequate fiscal space, thus leading to a downward spiral of debt defaults, debt restructuring, and further nature degradation. Sovereign debt markets must be sensitized to sustainability risk and so also reward material efforts to mitigate them. Now we have the opportunity. Sustainability-linked sovereign debt can help to tackle the issues associated with sovereign debt by directly rewarding positive nature and climate outcomes through reduced cost of debt payments, encouraging instruments that reduce risks through improved resilience and economic productivity, thereby lowering the cost of repayments across a nation's debt portfolio, supporting broader sustainable development outcomes directly through growth and productivity effects and indirectly by creating flexibility to support increased public spending, reducing the need for ex-post debt structuring by advancing smarter risk sharing between debtors and creditors. Well, the one that really grabs my attention there is giving them access to cheaper debt by encouraging them to act sustainably. I think that's a very good idea. Over time, this virtuous cycle can direct sovereign debt markets to embed sustainability risk into practice, regulation, and other rules, and so support more viable risk sharing. Expected outcomes: the sustainability-linked sovereign debt hub's success in addressing its core mandate will be judged against the volume and quantity of sustainability-linked sovereign debt issuance and its contribution to the development of relevant innovation, standards, and norms. The hub will provide a platform for relevant research, convening, and communication on all matters related to sustainability-linked sovereign debt. The hub will substantially increase the size of the sustainability-linked sovereign bond market, spread globally across a number of countries. It will facilitate access to a pipeline of concession refinancing and credit enhancement. It will support the delivery of the standardization of KPI-linked sovereign instruments to enable scaling up of KPI-linked debt issuances and reduce cost of deal structuring. So this body is all about getting SLBs up, as sovereign SLBs up to scale and making the case for their use, and they're supported by a range of organizations, including, well, I'm on the advisory board page here, but they have the support, where did I see it? Here, of the Sustainability-Linked Sovereign Debt Hub is supported by the State Secretariat for Economic Affairs, SECO, and that's part of the Swiss government, among other organizations. So I think that's enough detail for who they are. And now let me read this blog. It's called The Understated Benefit of Sovereign Sustainability-Linked Bonds. What could influence a country's debt management office to choose a sustainability-linked bond over a vanilla bond? Previous blogs have explored the relative costs and benefits of sovereign SLBs and data and governance requirements of SLBs, leading to this exploration of the understated benefits of SLBs. On the one hand, there are challenges and transaction costs of SLBs in terms of budget, time, and political capital, and the questions surrounding their pricing benefit. On the other hand, SLB issuance can initiate and accelerate urgently needed changes in both macro fiscal policymaking and public financial management, regardless of whether the bond is issued or not. This is because the back end of an SLB, the data systems and government processes underpinning the bond, can have multiple applications beyond the front-end sustainability framework that specifies the targets and KPIs. So that's actually a really interesting point, that even if a debt office is just to consider these SLBs, that's going to, in the process of seeing if this is viable, they're going to look to actually set up all these systems that may be useful in other applications. The narrow focus of the front end can provide a focal point to spur collective action towards climate-nature alignment, while the challenge of quickly building a robust back-end lends itself ideally to innovation techniques such as an accelerator. These features of an SLB therefore have the potential to unlock meaningful savings in the form of lower cost of funding through credit enhancement and signaling effects, economies of scope by spreading back-end installation costs across various policy use cases, not just debt financing, and economies of scale from spreading transaction costs over multiple issuances. Rising nature climate risks and mounting pressure from markets and civil society to implement sustainability commitments render the institutional changes and technological upgrades described above unavoidable. In other words, governments are likely to incur the costs whether or not the SLB is issued. Sovereign issuers are facing growing calls for enhanced sustainability reporting, which are being driven by the growth of ESG investing as well as increasing sensitivities to the macro fiscal risks emanating from climate shocks and biodiversity loss. The task forces for climate and nature-related financial disclosures, those are TCFD and TNFD, are being rolled out to corporates and have received strong endorsement by investors. It is only a matter of time before they are applied to sovereigns. Even the credit rating agencies are incorporating these considerations into their methodologies, albeit slowly and belatedly. Sovereign fiscal policies, financing plans, and bond disclosures will be increasingly scrutinised for measures to mitigate climate and nature risks. Those sovereigns that fail to disclose or take action to address emerging risks in their public financial management frameworks and systems will likely face penalties in the form of higher borrowing costs or, in the worst case, lockouts from international capital markets. As climate and nature risks crystallise, the risk premia demanded by investors will rise commensurately. Those that fail to produce credible plans, present dubious data, or demonstrate misalignment in key climate-nature policy functions may also incur a credibility discount in the price of their bonds. Taking these trends to their logical conclusion, it is not hard to envision a scenario wherein emerging markets and developing economies, EMDEs, are effectively decoupled from international bond markets. The rising refinancing risks at a time when sovereigns face a wall of maturities in 2024 to 2025 clearly implies an escalating debt crisis. Rounding out the doom loop, that means less funding for climate adaptation/resilience and biodiversity conservation, increasing vulnerability to climate shocks and nature loss, and worsening credit fundamentals. Multilateral development banks and development finance institutions can plug some of this shortfall, but only to an extent. They are already falling short on meaningfully closing the existing development financing gaps, let alone extra capital to roll over maturing obligations. Even if this funding were forthcoming under current rules, most MDBs and DFIs can only provide budget support loans that are tied to policy conditionality, in effect, targets and KPIs imposed by the creditor. Furthermore, budget support is based on an assessment of the government's institutional and policy framework and its commitment to and ownership of the reform programme. Meanwhile, the lumbering pace of capital adequacy framework reform means that the volume of policy-based loans is likely insufficient to meet immediate financing needs. They are also an inefficient mechanism to channel private capital from advanced economy institutional investors to EMDEs, given that MDB-issued bonds themselves are in limited supply. A more efficient mechanism would be for MDBs and DFIs to issue credit guarantees on SLBs covering all or part of the issuer default risk. De-risking would result in a credit rating uplift on the instrument and render them more attractive to risk-averse investors, thereby crowding in these substantially larger pools of capital and countering the threat of EMDE decoupling. As argued in this blog, SLB's general use of proceeds provision allows for refinancing conventional debt. Just important to note there that those words, SLB's general use of proceeds provision, so they're not use of proceeds bonds, which, to remind people, are like when you have green bonds or sustainable bonds or climate bonds or et cetera, where the bonds are earmarked for specific uses. SLBs are linked to a sustainability indicator, but they're not use of proceeds. So that actually frees up the hands of the issuers, in this case potentially the sovereigns, to use them for imaginative purposes or more imaginative purposes, for instance refinancing conventional debt. It therefore need not increase the stock of debt. Indeed, if they are used to buy back heavily discounted vanilla bonds, they can produce a reduction in the debt burden. By lowering the average weighted cost of borrowing, a guaranteed SLB would also have a beneficial impact on the issuer's debt dynamics. Furthermore, issuers have ownership insofar as they select the targets, while commitment is established through the incentive and performance tracking mechanisms embedded in the bond contract. Since the MDB's DFIs can achieve similar outcomes via a PBL or a guaranteed SLB, but can mobilise more capital with the latter, the case for issuing more bond guarantees for SLBs is arguably stronger. Even without credit enhancement, SLBs can lead to higher perceived creditworthiness, and by extension, lower credit spreads, to the extent that it signals greater policy effectiveness and reduced susceptibility to event risk. Policy effectiveness is a concept that features prominently in sovereign risk models. For instance, both Moody's and Fitch assign significant weight in their respective sovereign rating scorecards and models to the World Bank's Worldwide Governance Indicator, of which policy effectiveness is a core pillar. All agencies make qualitative adjustments to reflect policy coherence and predictability, as well as exposure to contingent liabilities. An SLB can hit all of these notes if it is properly structured. Aside from direct savings on the cost of borrowing, an SLB can also defray the cost of setting up a sustainability policy framework and data architecture with multiple use cases across government. Climate change and biodiversity loss are complex public policy problems that cut across virtually all policy domains, and the sustainability targets and KPIs in the bonds are likely to be shared across multiple government agencies, even if they differ in focus and emphasis. For example, a robust forest cover monitoring system has numerous uses well beyond biodiversity conservation, including water resource management, wildfire management, silviculture, land use planning, drug enforcement, and more. By selecting a few specific time-bound targets and a clear set of KPIs to coalesce around, the SLBs can act as a focal point for interministerial collective action. The market scrutiny surrounding these KPIs also ensures that the foundation is up to standard. Where it is not, an SLB can provide an impetus for getting it there. The cost of adding new targets and data streams can fall significantly once a technological and institutional foundation is laid down. Likewise, once the system and governance arrangements are in place, they can be used for subsequent offerings, even if the targets are new and substantively different from those before. Many of the extra processes entailed in an SLB, as described in Figure 2 below, are one-time upfront expenses that can be amortized over time. The key actors in the issuance process, as well as prospective investors in SLBs, will have been familiarized with the concept of performance-based financing, and presumably require less socialization via roadshows and the like second time around. For example, it took Chile more than 2 years to structure the first SLB that was placed in March of 2022. And they have details on the Chilean SLB. The second SLB issuance took place a year later and included a gender equality KPI. Therefore, if the data architecture is open and modular, then adding new modules and application should be relatively straightforward. This approach of piecemeal construction based on specific solutions to immediate problems is in keeping with the logic of agile development, whereby innovative systems are built quickly via an iterative process of learning by doing, as opposed to charting out a detailed path in advance. This is also the thrust of the accelerator we examine in our next blog, Accelerating Sovereign SLB Transactions, Building Out the Ecosystem. So that brings to a conclusion that blog on the understated benefits of sovereign SLBs. I have to be honest and say that some of that went over my head, but some of it didn't. Some of it went into my head and some of it went over my head, a mixture of the two. Very technical, and I'll be interested to see if there are maybe slightly more eye-level resources and that can be read to discuss this. But for those who are really familiar with the bond space, that might have been all good material. Thanks for listening to this episode of Readings in Impact Investing. My name is Daniel Rosehill, and if you want to subscribe, as I mentioned, it's readingsiниmpact.org. Thank you very much for listening. Until the next episode.
Thanks for listening to another episode of Readings in Impact Investing, presented by Daniel Rosehill. If you enjoyed this episode, then why not share it with a friend or colleague? And consider leaving a review or rating to help spread the word. Don't forget to subscribe via readingsiниmpact.org or find the show on your favourite podcast platform. Thanks for listening, and we'll see you next time.